Good morning, students. Continuing our lecture on the topic security valuation, I, CA Ashish Gupta, will take up the session on the topic left over, that is bond valuation. So, student, please note, basically this topic is not exactly we can say bond valuation because bond is a kind of a long-term instrument. So we can say it like that. It is a fixed income security valuation. So student, in today's session and on a forthcoming another session, I will discuss you nitty-gritties about the bond valuation. So student, let us start the session. I, see Ashish Gupta, Deputy Director of Auto Studies Academics, will take up this session. So student, you are free to ask your queries during the session as we have requested you earlier also, and we will share also our phone number as well as our email ID. So students, let us start valuation of fixed income securities. Now students, when we talk about fixed income securities, basically we can say we can divide it into two broad categories. Okay, one category is your bonds. Okay, normally their duration is more than 3 or more. Okay, whereas there are money market instruments which are normally for ranging from 1 day to 365 days, that is up to 1 year only. So there are broadly two categories that normally we cover here. Okay, students. Now, when we talk, first of all, we shall take up for our analysis the government bond, our bonds. So first of all, we shall focus our analysis on the bond valuation. Then we will come to money market, because bond is a more, of course, both are important, but bond are more widely, you can say, frequently used in our practice. Now, first we talk about first category of the bond is the government bond. Okay, because why government bond? Because the government of any country is the largest borrower, and they issue the bonds. For what purpose they issue the bonds? Normally for deficit financing. That is, if they have a deficit, you must have studied in your economics when the government have a deficit budget. Normally, to meet the expenditure, they issue the bond, and to meet the liquidity problem. Okay. Normally, for deficit financing, normally more currency is printed, but for main purpose is a liquidity problem. Okay. Now, next is very important for creating infrastructure facilities. Because infrastructure facilities, creation of the infrastructure facilities involves a huge amount. Okay, and it is the basically government of any country that they spend. Then how they spend, they normally issue the bonds. So government, we can say, it is a kind of a largest borrower of any main borrower of any borrower in any country. Now, when we talk about the government bond, there is one term is also associated, that is called, these are also called gilt edge securities. Government bonds are also called gilt edge securities. So wherever you see this word gilt edge securities, it means basically it is a government bonds. Okay. Now there is an interesting logic behind this. Why this is called gilt edge securities? Because there was a time earlier. There was a time. Now everything is on. Say you can say now everything is in dematerialized form. So earlier there was used to be what happened. These bonds were, whenever they were issued, their edge were used to be of a golden color. So that's why they used to call gilt edge securities. This is a traditional customary that we normally call it as a design. So it is only for your knowledge. There is not that much involved for your practical purpose, not for your, you can academic purpose, but it is also for the knowledge. Now, when we talk about these government securities, normally their duration range from 5 years to 40 years. This is normally they carry very huge period. Okay, I remember when where I was earlier in my previous organization, I will also share my more experience on these government bonds because I have practically worked in these government bonds. So I remember it was a time somewhere around 2003. Okay, so we used to since we have our own provident fund trust. So normally we used to acquire these government securities because normally these securities are acquired by the pension funds. Okay, PF trusts. Why these are carried this way? Because they are normally considered as risk-free. Normally the default risk is such securities is zero. Okay, so that's why these securities are normally considered as risk-free securities, and pension funds and PF trusts normally invest in these securities a huge amount. So, and normally there was, remember, I recall that it was around 2000, somewhere around 2003. So then we were in the process of acquiring the bonds. So I remember that the securities were likely to be mature in 2023. So there was a time of say 20 years. So I was thinking, oh, that much of time. But now could I realize that just 2023 is nearby. So normally they carry a long period. Okay. Another important features, these are issued by RBI on behalf of Government of India. Okay. Now earlier these securities were normally subscribed by the PF trust, pension trust, but recently government even has opened the window for retail investor also. This is the latest development. Even now the retail investors can now invest in the government securities. So this is I think somewhere around government has come out some guidelines that they can invest by through the retail window. So this is the latest development. So now the government, you can also acquire the government securities. So this is the main feature, and one more important feature, these are also issued by the central government and state government, both issues. So normally every government issues for their own purposes. Both government issues the bonds. Okay, now we come to the another category, that is state bonds. Basically state bonds, we can say these bonds are normally simple, like you can say whenever any company, because you must have heard a term when you were in the 12th class, there used to be a question on the debentures. So somewhere debenture and the bonds are similar, only except there is some difference of any, you can say, secure hypothecation, like clauses are there that maybe debentures may be more secure, bonds that may not be that secure. But otherwise nowadays, since both terms are used interchangeably, so whenever we in our financial analysis, normally we consider both terms same. So state bonds, normally we imply that a corporate bond. These are generally I'm sorry, I wasn't. Debentures are normally unsecured and internationally, but bonds are normally secured one. Okay, so but in India we use it interchangeably. Okay, now now we will talk about the plain this bond, straight bonds. Normally they are plain vanilla bonds. Okay, they normally carry some interest payment. How they carry the interest payment? Normally they can say the 8% bonds. Okay, 7% bonds, like that. So their interest payment, this is called coupon. This is called coupon. Okay, now this payment can be normally on annual basis or semi-annual basis. So annual basis means the payments are made yearly. in this payment are made after 6 months. Each 6 months you get the interest payment. Okay. So and normally, like if we talk about how these are made, normally the periods it's vary from 5 to 7 years. One more important point: when we this type of a bond normally carries what is the cash flow pattern attached with these bonds. The cash flow pattern attached with this bond is like that. Say this is 0 year. If I say 1 year interest payment, say if I'm taking say 7 years, 5 years, okay, to 5. So this is interest, this is interest, this is interest. In the terminal year, along with the interest, principal is also repaid. So this is a form of a straight bond. Okay. Normally, if the duration is more than 10 years, it is normally called the note. Okay, up to 10 years, they are called normally the bonds. Okay. Next category is the Sairam is asking, sir, who is retail investor? Retail investor like you and me. Okay, because institutional investors normally purchase the bonds in a huge quantity, whereas our kinds of people, only retail investors, have a small amount of money for investment. So we purchase only 1 or 2 bonds, or maybe 10 bonds. But retail investor purchase 1,000 bonds. Okay, not retail investors, institutional investors. Retail investors normally purchase in the smaller. So we are the retail investor. Now next comes the zero coupon bond. Zero coupon bond, beta, it is basically why it is called zero coupon means interest. It does not mean that interest is not paid. Of course, interest is paid, but that is paid collectively. Okay, interest is paid collectively. Whereas in our previous example, we have seen the interest has been paid at the first year, second year, third year, fourth year, and at the end of fifth year also, along with the repayment. Here in this case, what happened? The interest is paid at say 0, 1, 2, 3, 4, 5. So no interest, no interest, no interest. Here the amount will be paid principal plus interest. Okay. So what happens? That's why zero coupon bonds are issued at discounted value. And redeemed at face value. Okay, like here we see that here the total amount of interest, if say the interest is say 10%, I'm just for the convenience, or we can say it is assuming 8 rupees 888. So overall 40 rupees has been paid during the 5-year tenure. Now when we talk about the zero coupon bond, here the debenture will be maybe issued at 950 and will be redeemed at 1000. So this difference of 50 rupees will be considered as interest. Now student, you can see that normally in a zero coupon bond, they carry the higher interest rate than your regular bonds. Why? Because here the time value of money comes into the picture, because here the investor is getting earlier money. Okay, so of course, whereas here in that case the investor is not getting the money earlier, he is getting the money straightforward after 5 years. So here they normally have a compensation for the same. So that's why they are normally they have some more interest element there. Now I want to discuss a very important thing. It was somewhere around in IDBI. I remember that IDBI in 1996 come out with the bonds, and I remember that somewhere bond was around 5,300. Okay, and for 25 years. Okay, that is 2021. So, and repayable amount was 20,000. So you can see that the difference between somewhere around 14,700 is towards the interest payments. So there are various kinds of bonds are possible. Zero coupon bonds are possible. And normally when we shall see the valuations are quite different of the zero coupon bond. Now I am coming to the floating rate bonds. Now student, in a floating rate bond, the main feature is that they are normally linked to some benchmark. Okay, and just for example, this what is this benchmark rate can be? It can be prime lending rate, repo rate, or it can be LIBOR, MIBOR. One it can be MIBOR, LIBOR, or any other. So please remember, this LIBOR is going to end within December 2021 because around 40 days have been left for this LIBOR. Okay, that I will discuss after 2 minutes. Now, student, let us see what exactly floating rate is. In a floating rate, the interest rate is reset. Okay, how it is reset? In our earlier example, we have seen if this bond is carrying 8% of interest. So our interest payment was 1 minute. Our interest payment was 88 rupees each year. Whereas in floating rate, what happens? At the every year reset period, the interest is reset. Okay. Now how it is reset? It is reset on the basis of some benchmark. Okay. So because and in benchmark, what's that? Normally we add some spread. Okay, this spread is decided in advance. For example, a company may say, even I think 1993, I just give you an example. In 1993, SBI has come out with this bonds. Okay, and the face value was 1,000 rupees. Okay, now what was the condition? It was saying 3% over and above bank's maximum term deposit rate. That is FD rate. The maximum duration may be say 6 years or 10 years. Whatever is the FD rate, the SBI will pay the interest of the 6 years. Now suppose on 1994, on 1st January 1994, the FD rate is say 6%. Okay, so the bank will pay for the 1994 will pay at interest at 99%. Okay, suppose on 1995, 1st January, the interest rate has come down and it has come down 5.50 FD rate. So they will pay you 8.5. Similarly, also on the 1996, the interest rate has suppose again has risen. So they will pay you 8.75%. So this goes like that. Okay. Now, student, this is called spread or margin, we can say. So, but and normally it is not expressed in the term of percentage. Rather, they are expressed as like 300 basis points. So it is equal to 3%, and these basis points will be very commonly used in the finance. So please remember, students, one basis point is equal to 1 divided by into 1%. That is 0.01%. Okay. So wherever you have to express 0.01%, you have to call it as a 1 basis point, and 300 basis point, if we multiply the same, it becomes 3%. Okay, student. Student, please just understand. Just initially, I am discussing with you the theory, because whenever we discuss a topic of bond valuation, it is very essential that we should understand the each and every aspect of the bond. Then only we can understand their practical aspect in very good manner. Now, next, we are coming to the convertible bonds. Now, when we talk about features of the corporate bond, this is also called embedded bonds with embedded options. Embedded options means they are, you can say, they give certain rights to the investor or the borrower, both. It can both be possible. Okay, so in this category, first we discuss the convertible bonds. In convertible bonds, the holder is given a choice for getting converted debentures into the equity shares. Okay, so how it normally what happens at the time of maturity, like in our example, say we have seen here, the bond is carrying this value. Say the bond is of say 100 rupees. Okay, so they are paying 8 interest. In the end, when the interest plus principal is repaid and principal amount is 100, in that case, the company may give the choice that either you can go for a redemption of the principal amount, or what you can is given an option that you can get converted your share. Say one debenture, one bond is equal to 5 shares, equity shares. Now there is a separate topic for our discussion, convertible bonds. So where we shall discuss in detail, but just simply I am saying, now suppose when the debenture bond holder will go for this option, when it will be the offer will be lucrative for him. Suppose if the rate of if the equity share is trading around somewhere around say rupees 30 per share. Okay, so in that case, what will happen? The borrower will immediately go for this option conversion, because he will get 30 shares, sorry, 5 shares, which are worth in rupees each 30. So ultimately, he is getting say amount because by selling in the market in the immediately conversion, he can get 30 rupees per share, and the amount that he will receive 150 instead of rupees 100. Of course, he will go for this option. Now, if the price is somewhere around say 18 rupees, so ultimately he will get 90 rupees. He will not opt for this option because he will be at a loss. Now, if the price is somewhere around 20, now in that case he will be indifferent. Okay, either he can go for a redemption of the bond or he can go for a conversion, because in both cases there will be a same cash inflow will be of rupees will be incurred for him, will be occurred to him. So it is very important that what exactly in case of a converter, what market price are prevailing, that is more important. Okay, and there are some other aspects also involved with the converter loan. We shall discuss when we shall discuss the topic in detail. Now, when next category is callable bonds. Now, student, as I told you, it is an embedded option because it has given some right. Now, callable bonds means it gives the right to the borrower before the due date. Okay. Now, in this case, what happens? The borrower normally, what happens? The borrower have a option that they can recall the bonds. Now, if you recall that when I was discussing in my first class, there was simply I have taken the discuss small topic bond refunding. Okay, so in a bond refunding decision, why the bond refunding one decision? Say, I just give a small example. Now, suppose a company somewhere around in 2005, when say interest rate was somewhere around 9%, they have issued the bonds. Okay, now that maybe say tenure maybe around 20 years. Okay, now they are likely to redeem say around 25. Now suppose today the interest rate may be hovering around 7%. Okay, of course they are paying 2% more in the to the holders. So what the company can do, they can redeem, they can premature the bonds. Okay, but this right involves a cost. Normally, if you recall this question, there was some term called call premium. Okay, normally at call premium. So ultimately, what happens? The company cannot do this. Give the right. Company does not. You can exercise this right at a free. They cannot do it arbitrarily. Whatever comes to their mind, because they have to pay some premium to the investor. So this call premium normally is a premium that they pay to the investor for maturing the early maturing the bond. So that's why they have to make a decision whether we should go for a refunding calling the bonds or not. Okay. And normally what happens, it is very important when we shall discuss the topic in greater detail. Normally there is some transition period. Okay, what happens? Say the company has decided on say first for 2021 that they will redeem the bond and will issue the new bonds at say 7%. Okay. Now what does the company do? Normally what happens whenever a company calls the bonds, they normally issue the new bonds for making them repaying the bond. So what happens? Say they take a decision. They will say we shall issue on say 1/7 21 we shall issue the new debentures, the bonds. Okay. However, these bonds will be refunded on exactly on 30 September 2021. So till time these bonds are refunded, the both interest have to be paid. That is 7% as well as 9%. So for these 3 months, the interest will be paid on both. So this is called transition period. Okay, so that we will discuss when we shall take up the topic of bond refunding in greater detail. So callable, I hope that exactly what exactly the callable term is clear to you. Now normally what happens also, student, whenever company this issue these callable bonds, they come out with the call premium schedule. Okay, in this schedule, what they say, if we redeem after 5 years, the redemption will be value, say, if the bond face value is say 1,000, they say that we shall issue, we shall make the payment of 1050. Okay. Now, if they say if we redeem after say 80 years, we shall pay you a premium of this. Okay. If say the period is 15 years. Okay. And if they say if we call or exercise our option after 10 years, we shall pay you 1020. So they can come out with the call premium schedule at the time of issue debenture, then because it clearly indicates the premium. Here 50, here it is 30, here it is 20. So they can come out with the schedule also. Okay, students. Now we are coming to the next bond with embedded option, that is called puttable. Now, student, call and put option will be clear to you when we shall discuss the topic of derivatives. But I'm just for your knowledge, I'm sharing with you. Puttable bonds gives the right to the holder to get maturity before its due date. Okay, in this case, like here the company was borrower, that is the company have an option here, rise to the borrower here the right to the holder, that is investor. Okay, student. So they have a right that they can submit their bonds for the early redemption. Okay, of course they will give when they have some benefit. Okay, they have another investment opportunity. So normally it depends upon person's personal preferences, investment opportunities, many factors play a role. Okay, student. Now, now next comes the choice of currency. Now, student, here, if you have heard a term, foreign currency convertible bonds, FCCB, I think you must have some idea. So, yeah, or we can say if you have termed the external commercial borrowings. Okay, now what exactly external commercial borrowing is? Now, in the external commercial borrowing, the company issues the bonds in foreign currency. They are also called the euro bonds. When a company, what is exactly the term euro bonds? If we say euro bonds, second. When we say the term euro bonds, what exactly it means? Basically, it does not mean that these bonds are issued in euro. The term normally implies that whenever a country, whenever a company issues bonds in any currency other than its domestic currency or home currency. Okay, so under this category, in India, we have allowed the foreign currency convertible bonds. Sir, give the example of the puttable bonds. Sairam, exactly, I not recall any example puttable bonds because normally they are least issued because most it is only for the theoretical purpose. Normally, a company issues the callable bonds because they want to have the rights among them. Okay, and because normally what happens, I just want to share with you. Normally, the debenture bonds are never discounted at not redeemed at a discounted price. Say if the face value is 1,000, so redemption normally will be at a par value or more. It will never be at a discount value, say 990, like etc. So, but that's why the normally the company does not give this option to the holder that they can put there. Normally, they keep the option with them. It is just for the theoretical purpose only. So, I have never come across in my mind. There is no any example. Maybe you can check it from the website, but I never find any example there where the company has come out with this portable. Now, when we talk about the foreign currency convertible bonds, now, in this case, what happens? The a company may Indian company may issue say Indian company issues bonds in dollars, US dollars. So there is a called the put you can say euro bonds. So now in this case, or even the term foreign currency convertible bonds, foreign currency convertible bonds has been in this case the interest is paid in dollars. Okay, and at the time of maturity, the bonds are converted into equity shares. Okay, and student believe this around say somewhere in 2008 when rupee was strong. The company issued many companies go for this option foreign currency convertible bonds because the rate of interest somewhere around outside India was somewhere around 4%, where in India it was somewhere around 9%. So companies have started considering that why should not we issue the bonds in the dollar so that we shall pay the less interest. But when we shall discuss the uh, topic of foreign exchange, that it will be very clear to you because when the in 2008 when it was issued, so dollar was somewhere around 46, 45. Okay, but when after say 5 years around 2013 or 2012 13, the dollar was somewhere around 57. So this 12 rupees depreciation has wiped out the benefit of their bond. So that's why they have come out. I hope you must have understood. So there is always a risk in this type of a bonds when a company issues. Of course, because there is a exchange rate is very important, and this exchange rate it will be very clear to you when we shall discuss a topic of. Only just for the sake of your knowledge, just I'm briefly explaining here, but we shall discuss it in greater detail when we shall take up the topic of foreign exchange. Now here there is another term you must have heard, masala bonds. Okay. Now these masala bonds are issued to offshore investors denominated in Indian rupees. Please remember, masala bond does not mean that they have a masala flavor. Only since they have been issued in India, so these are called masala bonds. Like the bonds are issued in Chinese or Chinese renminbi. They are called the dim sum bonds. Okay. Now, similarly, I think the bonds issued by Japanese companies denominated in Japanese here are called samurai bonds. So these are some terms have been associated, and I think with this one another, I'm not recalling his. I think in a between we call it as a bulldog. Maybe I'm the two terms I'm sure, but for the other terms you can go for website. So in case of a masala bond, what happens? They are issued in Indian rupees, INR. So they have a choice. We can say that choice of the currency means they can have a choice. They can issue in the dollar or they can issue in the INR. Okay. Now, when they issue the in INR, of course, the rate of interest will be higher. Okay. But what is the benefit to the company? The exchange rate is hedged. Because here what we have seen here, although the interest was 9%, in India it was 5%, but due to this exchange rate risk change, the company is incurring very huge losses. So accordingly, they can go for this masala bonds that is called, they are issued in INR and also repaid are in INR. Okay, students. So I hope that this term will be clear to you. Student, please note, these are normally, I'm just discussing with these terms with you because normally whenever you are after qualifying your examination, I have observed that even some students are not you can well versed with these terms. So they should be have some knowledge about these terms also. Now we are another coming to the features of the bond. It is called amortizing features. Amortizing features means what is the pattern of their payment. Now there is another bullet repayment. Bullet repayment means say a company like in this example, if we go by our back example. Well, I take just I don't need it, yeah. So we have to go a long way. Now suppose a company comes out with a bond issue. 7% bonds, face value 10,000. Okay, coupon payment yearly. So, and the duration is say 5 years. Okay, now here 700 interest, 700 interest, 700, and in the terminal year 7 plus 10,000. Okay, so students see this is called bullet repayment. Okay, this is called bullet repayment because it is repaid in a one shot. Okay, it is repaid in a one shot. Okay, on the other hand, there is another category that is called over the life of the bond. Okay, in this case, this is here the repayment is not made only on a one bullet payment. Just I show you. Okay, student. So I'm just taking the same example here. Here, what I am assuming that 2000 will be paid back each year. Okay. So of course, this is first year. Here our interest will be 700 plus 2000 our principal amount. So next year our bond value, because principal will be reduced. So here our interest will be 560 plus 2000. Okay. Next year the interest will be 420 plus repayment is 2000. Okay, student. Now here next year this interest will be 280 plus 2000 repayment, and in this terminal year this interest will be this. So here, student, we can see this 2000 is repaid back in every year. Okay, and accordingly our interest amount is keeps on changing because the principal has been reducing day by day. So this is called a amortizing feature over the life of the bond. Okay, student. Now, normally this type of bonds are rarely exist. Normally they are used in the securitized instruments that Divas sir has discussed with you what exactly is securitization. And because in securitization, what happens? Because securitization is a pooling of the receivables into the securities. And when the receivables are repaid back, So ultimately, the principal is also start getting repaid. So in amortization, and that's why they are normally used in securitized instruments. This type of feature is there. Now next we are coming out with the junk bonds. These are bonds are issued by company without any proven track record. Or even we can say these are issued by company near to default. Okay. Normally, what happens? There is a concept of credit rating, and this credit rating is concept where if you have heard the term credit rating, because every day you must have heard the term that Moody has downgraded the India's rating. Okay, Modi has downgraded because if you start, as I told you earlier, if you start reading any financial newspaper, so you will come across these terms. And now in this case, what happens? A company may give the poor credit rating to any company, and not correct company, a credit rating agency. So in that case, why this giving a poor rating agency poor rating? Because there may be the credit rating may have an apprehension that the company may have a difficulty in the repayment of its payment of interest and repayment of interest. So normally, whenever there this company which having any poor rating, they issue the bonds. 1 second. One second. Second. So whenever this company is having a poor rating, they normally issue this kind of a bond. Now I can give you one example, very good example. One second, sure. I'm just sharing with you an example. Recently, somewhere around in I think 1 year back or maybe somewhere near, a company called Keshoram Industries. Okay, so Keshoram in the industries they have issued these bonds, junk bonds, and you won't believe that even the Goldman Sachs and Edelweiss Financial Services has another one or two companies, investment banker has purchased 16 billion rupees, 16 billion bonds, junk bonds, yielding a rate of return of 21% from this company. So now normally these companies carries a higher interest rate. So they were carrying 21%. Okay, because there is a risk of the default. So these are called the junk bonds. Okay, student. Next term is the terms of maturity, terms to maturity. Now, in this case, uh, normally these are terms to maturity means the company may issue the bond say for the 7 years or for 10 years or they more than it. So it depends upon their choice. Normally, what happens uh, now when we talk about the terms to maturity, there are one or two things come into the picture, and that is called we can say there is a one term structure. I think you must have heard the term structure in your uh, I remember that whenever you discuss a topic of bond, because it is kind of a term structure means how the interest rate are determined. As normally the company may have, we should discuss. There is a separate topic term structure because it depends on the apprehension of the investor. So it depends on the trend. When a company may come out with the say 2 or 3 issues, they may saying that okay, we are coming out with the issues of the bonds, say for the 5 years, 10 years, and 15 years. Now in that case, the it depends on the perception. If the rising rate of interest are there, of course the 5 year bond will carry lesser rate of interest, and a 10 years bond will having a higher rate of interest. So it depends on the term structure of the interest rates. 1 second, student. Okay, student. Now, in the term structure, when you talk about here, we can say that the period may be ranging from say 5 years, 10 years, and 15 years. Okay, student. Now, suppose a company is coming out of the three bonds. Okay. Now, first 5 years. Okay. Another is 10 years. Another is 15 years. In that case, what happens? Now, it depends on the volatility in the market. Okay. If the market is too much volatile, okay, so then they may say for volatility, you know that volatility is indicated by the standard deviation that we have discussed in the topic of portfolio management. So normally, if the higher the volatility in the market, so higher will be the same. If they are issuing for the 8 years, for the 10 years, they may will have to issue some on higher side, and for 15 years, they may have to even issue at a 11%. So it depends on the volatility of the bond because, and it depends on the term structure. Okay, if the rate of interest term structure is like that, with the time period, the interest rate will be on rising. Okay, so we shall discuss when we should take the topic of term structure, but for the time being, it is for your knowledge. Now we are coming with the last term, perpetual bonds. Now, student, this term you have heard when we are discussing the topic of cost of capital. There, if you recall that there was a formula of the KD. The formula of KD, if you recall that, just hold for a second. I'll just get you. Hello, my voice audible? Okay, okay, because there was a student was saying that your voice is not audible. Okay, can I continue? Okay, okay, okay. Okay, student, just check at your end because I have checked it. Okay. Now, student, where I was telling you about, there was in normally these are issued at 81 additional tier 1 bonds. Okay, and they carry a because they are normally just like equity. Okay, so normally they are never paid during the life of the bonds. And of course, the company can issue with a call option that they can redeem after say 10 years. But normally, practically, they are not used. And practically, they are less used only in case of banks are they are used. Okay, student. Now I am coming to the next topic. Now, student. Now with this, till now there were some basics about the uh, discussion on this pricing, this bonds basics. Now I am discussing with you the how we determine the value of the bond. Now, whenever we talk about valuation of the bond, what is more important? It is first of all, it is just like a capital budgeting decision. Always remember that it is like always a capital budgeting decision. Okay, student. So here, what are our expected cash flows? Okay, what are our expected cash flows? Okay, now what are our expected cash flows? Our cash flows incur for investor. These interest in the payment form of interest. Okay, and principal repayment. Okay, principal plus this principal repayment. So as we have discussed in our previous example, like here, just I'm showing you, our interest was say 700, 700, 700, 700, and in the end it is terminal year. It was 700 plus 70 and this. So like this here, first of all, we discuss what are our expected cash flows. Okay. So this determines the pricing of the bonds. Sairam, can you repeat the perpetual bond concept? Better see, perpetual bond concept means normally these are never redeemable. It is kind of an infinite period. They are issued for an infinite period. If you recall that. So normally what happens? Perpetual bonds are not practically that used, but normally a bank are used for making this additional tire requirement, additional tire. So these bonds are normally carry the additional tier 1 requirement. You will discuss, you can refer it from the website also. Okay, student. Otherwise, I will. You can contact me over the telephone. I will discuss the on the greater detail. Uh, Now here the principal repayment are the important, and this is all our cash flows are involved there. So normally, first of all, like in capital busting, this year, if you recall that initial outlay was there, then there was the annual cash flow, and in the end there was terminal cash flow. Okay. Similarly, here our interest payments are annual cash flow, and principal repayment is our terminal cash flow. So these are the first basis of our pricing of the bonds. Now next is called the estimation of the required rate of return called yield. Okay. Now what is exactly the yield? If you recall that student in the, when you were discussing when we were discussing the topic of capital busting or the cost of capital, if you recall that. So there were you used to call IRR of a bond or debenture by using the IRR method, if you recall that, in the topic of the cost of capital. Okay, where the rate of interest has been given to you. Everything has been given, principal, repayment, everything has been given to you. But you need to recall this called IRR of the bond, and this IRR bond is basically called the yield. Now what happens, yield normally, what happens when we value any bonds, we consider the yield that is prevalent in the market. Now suppose it is, you can say it is the investor's expectation. Okay. Now, if an investor expects say 8%, but your bond is of 7%, so of course the investor will not ready to purchase your bond at 8% at a face value of 100. That we will see later on. They will consider they will like to buy it from this. So basically, the required yield, it is, you can say it is the discounting rate for discounting the cash flows. So cash flows is, we have this here, cash flows. Okay. Now yield, basically we can say it is a discounting rate that we use to discount the cash flow. So by this we can get the value of the bond. Okay. Now there are some whenever we value any bond, there are some assumptions that coupon rate is fixed. Normally it remains of, say company has come out with the 8%. So of course we shall consider the 8% for every year. But sometimes they may be changed if we are considering the, say, floating rate. Then this assumption cannot be made out. But what happens in that case, we have to estimate the floating rates in a forthcoming period. Then we can compute the present value of this bond. Payment of the coupon is made at a predetermined time period, annually or semi-annually. Student, as I told you earlier, the interest coupon payment, say it can be paid annually or it can be semi. Now, student, here it is, you need to remember, and that is a very common mistake. Say if I say there is a bond, 8% bond, which pay the coupon annually. Okay, so in that case, the 8 rupees will be for the each year. Now, if I say it is 8% bond semi-annual. Okay, so in that case, the payment of the coupon will be of 4. Okay, please remember the interest will be half. Okay, say if I say the duration is 3 years. So here my cash flow were like that. 8, 8, 8, 1, 2, 3. Okay, now if I say this semi-annual option, here the interest will be 4, 4, 4, 4, because this will be another first semi-annual, second semi-annual, third semi-annual, fourth semi-annual, fifth semi-annual, and sixth semi-annual. So accordingly, you can see here we can say that it comes the 6 payments. So please remember what we have to see, whether they are payable in a semi-annual or it is on an annual basis. The another assumption is it will be redeemed at par unless it's given to you. Namita, 1 minute. You have asked a very good question. 1 second, I just reply it. Namita is asking, sir, till now we have seen the simple interest paid on the bond. So there is any bond on which compound interest is paid? Yes, compound interest is paid on the zero coupon bond. Okay, because what happens, as I told you, zero coupon bonds carry some more interest because when interest paid is annually, of course, investor is getting it, say, coupon every year. Whereas in case of a zero coupon bond, he is getting the interest amount in one lump sum. So he is also getting interest on interest at the time of final repayment. Okay, very good question. Very good question, Nita. Okay, I hope in a case of it is clear to you. In case of a zero coupon bond, it is a concept where the compound interest is paid. Now it is very important, student. Bonds will be redeemed at par unless given otherwise. Normally, the bonds are always redeemed at par, means they are paid and repaid at a face value, unless and until given in the question. But they can never be issued at a discount. Okay, so it is very important that they are considered as a, unless they are given, you will consider as a par. Okay. Now I am just discussing with you the formula, how we value the bond. Okay, student. Now this is the basically you can say this is a kind of an annual cash flow, and this is you can say a terminal value. Okay. Annual, or we can say it is a kind of a periodic cash flow. Periodic will be the word will be better. And here, if we say that the C is our coupon rate, the C is coupon payment, T is our time, and our this is T is our time. R is basically I'm just writing here yield on bonds, and M is maturity amount. Okay, there is another version of this formula. Normally, it is you will also see in our books coupon into present value annuity factor. Okay, plus maturity amount, present value factor, present value, or we can see it like that here. So here it is in annuity because A indicates the annuity. Okay, so rest is the same. Okay, so this is maturity amount, this is coupon amount. So we can also represent the formula. So normally, whenever we calculate, we can either we can calculate in a form of say tabular form. Okay, considering the PV, then cash flow, then PV. Or otherwise, we can use the straightforward this way. Okay. Now I'm just simply discussing one example with you. Okay, just read the example carefully, and I show you how we compute the payment. Or I can do one thing, one second, student. Okay, it will be better if we consider this question here. Okay, just you read the question, then I discuss with you. In this question, it says the XY Limited has bought a value of 100. Coupon is 8 repayable par after a period of 4 years. Determine the value of the bond under the following procedure scenario, YTM or required rate of interest. So here we have given 6, 8, and 8. Here, student, please assume, note that whenever nothing has been mentioned, so you will always assume the coupon is payable at yearly. Okay, it has you have to assume because unless and until given, you will assume that the coupon or payment are yearly. Another assumption that redemption will be at face value, that is rupees 100. Okay, so we have a cash flows with us. Okay, and we have a redemption value with us. So we start solving the question. So I hope just simply note down 100 rupees, 8%. Okay, and period is 4 years. These are for 8%, 4 years. P is equal to this. This is our coupon. This is our maturity amount. Okay, and our PR is basically 3 categories of R are there: 6, 8, and 10%. Okay, now let us start solving the same. Okay. Okay. Now, if I start solving the same, say if YTM is 6%, of course, so as capital budgeting decision, 8% is my coupon rate. As I told you, in this terminal year, 8 plus 100. Okay, both will be there. Okay, let us calculate. Okay, student, if you have any doubt, you can ask me. Okay, student, now we are coming to second. If required yield is 8%. Okay. Now we are coming to the third. Okay. Okay, student, you also carry out the calculation yourself also. And in case if you find any difference, please let me know. Okay, student. Now, student, I'm just discussing with you what is exactly the relationship between the price of the bond and YTF. It is very important to understand that. Now, student, please, if you have noticed, here we have a three yields. Here the required yield is 8%. So our value was 106. Okay. When yield was 8%, our value is same as bond price. And when our required yield is 10%, our value is this. Okay, student. So now let us see the relationship. Okay. I'll just show you on a graph. Okay, students. Okay. Now say if my yield is 6%, the value somewhere was around 106.94. Okay, it was 100. Okay, when value it was something around 93.65. So you can see that there is an inverse relationship that as the yield increases, the price goes down. Okay, student. Now here we can say that at 8%, because coupon is 8, yield is 8, it is trading at par. Okay, so 1 second. Okay, student. So you have seen that when it is if there is a high, then it will be traded. Now I can show like that here. There is a table. One second, I think my screen is not visible. The screen is visible. No, 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 no. One. I think there is some issue. 1 second, I think it has stopped sharing. And let me share this. One second. Yeah, 1 second. I think there is some issue. Hmm. 1 second. Students, just wait for 2 minutes. I'm just the connection problem. Okay. Okay, students. Now let us see the screen. So here the required rate of return is equal to coupon rate, then bonds and at par value, as we have seen here. That is 100 rupees. Okay, because our 8% is required yield and 8% is coupon. Okay. Now when the required rate of return is greater than coupon rate, so coupon rate is 8% and required yield is 10%. Okay, so the price is 93.65. So it will be sales at discount. Okay, student. Now here, when it is above discount rate, yeah, if the required rate is less than our coupon rate, it will sell at premium. That is 106.94. So, okay, student. So I hope what is the relationship between the value of price of a bond and YTM must be clear to the student. Now Namita is asking, sir, there is a technical 1 minute. Let me, she has said that 1 minute. She has said, Namita is asking, sir, in study material formula YTM given in technical manner, please also. Student, actually, it is not in technical manner. It is simply has been mentioned that YTM, because YTM he has to calculate, because it has not been explained how the YTM is calculated. You have to calculate at your own. When we shall do the questions, then you will get the answer of your query. So please have some patience and we have. Now, student, one more point here I would like to mention that just I'm sharing with you. Now, whenever say if the coupon payments are semi-annual, then we have to half the coupon as well as our discounting rate. For example, if I just go back to my example, this if I say this same example, if I say this, the coupon rate is half, this interest rate is payable at semi-annually, then what will be the position? Okay, so the formula has been given in the study material, but just let us see. Here, the discounting will be like that. Okay, student. Now you just compute the value because I have not computed at my own. Just give me the answer. What is the value? You can say like that, 4 into 0.971. Okay, one student has Arshad Gohil has computed the answer. Arshad, thanks a lot. I just checked the answer. Maybe you may be correct. Any other student has computed the answer? Please send your answer, beta. Harshad Gohil again has sent revised the answer. Now I think your answer is correct. Let me check it. I think Harshad, your answer is somewhere correct nearby because approximate there may be some difference. Now, student, you can also verify whether my answer is correct or not. My purpose you make to understand that, but you have to have this coupon as well as discounting it. That you need to remember because this is a very common mistake students normally commit in their examination. Okay, one or more two answers are there. I think yes, Amita, your answer is correct, beta. Very good. It means you are attentive. And student, please always remember that whenever during the class you carry out the calculation yourself, you will keep it in your it will keep it in your mind for a long time. Okay, it is always a good practice that you should practice along with us. Okay, student. Now I think the relationship between clear to you. Now I'm coming to another important term that is quotation for the bond. Now, student, please note whenever the quotations are given for the bonds, they are normally given like this. Like quotes are 98, 85, this. Now, what is happened? Normally, they are presumed that face value is 100. They are based on the assumption that face value is 100. Accordingly, we divide it by the 100 and we get this value into converted decimal points. Okay. And whatever be the value, par value of the bond, we multiply with the same. Okay, and we get the price of the bond. Okay, so this is basically quotation for the bonds. You may be for some time you may be given the examination in the question like in this manner. So you, whenever the quotations may be given like that, you always assume that the face value is 100. Okay, of course, the par value of a bond may be different. Now, please read the slide carefully. I am discussing with you an important point. Now, student, what happens? Difference is down. Okay, yes, Harshad, your answer is correct. But you can keep it up to 2 decimal point. I think you answer, because I think you must have taken the percentage factors. I will give you a clarification regarding decimal points when we will take in the final session. Now, student, there is a term like that sawtooth pattern. Now, what happens, students? Here, the price pattern of the bond may be changed due to accrued interest. Okay, now what is exactly meaning by that? Now, just I explain it to you. Now, suppose a bond has been issued, okay, and interest is payable semi-annually. It has been issued on 1st 2020. Okay, so first interest payment will be on 30th June 2020. Then it will be at 31st December 2020. Then it will be at 30th June at 2021. Then another payment will be at 31st December 2021. Okay, student. So now suppose a person acquires the bond at say 1/9/2020. Okay, now what happens? Of course, when he will acquire the bond, the coupon bond payment, say if I say the bond is carrying 8% and the face value is 1000. Okay, now bond may have their value. Okay, whatever is the price that will be available. Okay, now what happens here? On 30th 2020, the 4 rupees have been paid to the coupon holder, that is bond holder. Now, when he is acquiring and 1st July, it carries the interest for period 20 to this. So for these 2 months, okay, now for the sake of clarity, I'm just considering here, it will be more easier for us. Okay, let us consider this date as 110. Okay, now when he is acquiring the bond on 1/10, okay, so the interest that this bond will carry, sorry, my mistake here, I'm just checking it. Now next payment will be for this period. Okay, so what happens? when he is acquiring this bond on 1/10/2020, it will carry accrued interest for the period 1/7/2020 to 30th September 2020. For these 3 months, the accruing interest will be accrued to him. So what we do? We say the accrued interest will be 1000 into 8%. Okay. Upon these 3 months. Okay. So this 20 rupees, when he will buy the bond on 1/10, 1 October 10. So this 20 rupees will be added there. Accordingly, what happens on 1/1/2020, the price of the bond is here. Okay, as the time passes, okay, on 30th June, the price will be here because it is having a 4 rupee interest element there. Now, once this interest is paid on 1st July 2020, the price will come here, interest element will be here, and again interest will be there. Okay, now here interest will be there, so this will be the your 31st 2020 on 1st January 2021. Here what happens, the person is purchasing bond on 1/10/2020. So accordingly, the interest for the 3 months will be accumulated in this. So accordingly, we can say that the two pattern accrued interest, here we have to add the accrued interest, coupon amount, days since last payment, and days current of the in the current coupon. Okay, so we normally, like here we can say that coupon payment is our coupon amount is 80. Okay, and here coupon amount, sorry, it is, let's say it is 40 because coupon is half year, and days, or we can say, if we can say like that, 90 upon say 180, like that. Okay, so this way we can calculate it like that. Okay, student. So we see this pattern, and accordingly, our price quotation is like that: clean price plus accrued interest. Okay, this is called dirty price. Clean price means the intrinsic value of the bonds at which you can purchase the bond, considering there is no accrued interest. Okay, and if we element it is element, we tell the student, please note that dirty price of that we saw this sawtooth pattern. Here, if you recall that there is a term, come dividend. It is just like that concept. What is come dividend? Now, suppose a company share is trading at say 70 rupees. Okay, now company has declared a dividend of say rupee 2 per share. So of course, it may be possible that the company share will start trading at 72% because 70 is our ex dividend price and 72 is our come dividend price, because whosoever will buy the share will get the debenture dividend of 2. But in case of a come dividend, normally the dividend, this concept is not frequently used, because what happens, this dividend is not sure. It normally declares by the company, whereas in case of bonds, accrued interest is by default there. Okay, accrued interest are by default there. So of course, they will be considered in every sale and purchase. They are by default. Accrued interest is by default. So whenever we have to purchase or sell a bonds, we have to see the time period between the last payment and this. But normally, practically in our questions, you will see that normally they are valued without accrued interest. However, this concept is more important in case of money market instruments. In money market instruments, this concept is very important because in money market instrument, normally they are purchased for 1 or 2 days, 7 days, 8 days. So that's why they are more important. Now, accordingly, the clean price will be the equal to cash price, dirty price minus accrued interest. So this is nothing but is interchanging of the equations. Okay. Next, we are coming with the yield measures. Now, when we talk about the yield measures, normally we employ some measures that whenever we analyze the bond. First measure is the current yield. And what is the formula for the current yield? It relates to the annual coupon and the current market price of the bond. It is very important. Okay, it is not the face value. Normally, student commit the mistake here. It is not the face value, rather it is the current market price. Okay, now just I show you. Now suppose 8% coupon is bond. Is selling at 817 rupees. Okay, wherever the face value is rupees 1000. Okay, so the current yield will be 880. Okay, because coupon payment will remain the same. It is on the coupon payment is based on your face value upon 817 point. Sorry, my mistake is just consider as a 8.50. Okay, into 100. So the yield comes 9.79%. So you can see that if the coupon is bond is selling at discount, our yield will be higher. Okay, our yield will be higher. So accordingly, we can draw out a relationship like we have drawn out the relationship here in the equation. This equation. Similar effect we can show here. Okay, beta? Now, when this will be seller discounting, it will be seller discounting when our yield is higher than our coupon rate. So accordingly, we can say that if coupon rate is greater than, we can say is lesser than yield, so our bond will be sold at discount. Our current yield will be higher than coupon. Okay, if the coupon rate is greater than yield, the bond value will be at premium. Okay, so our current yield will be lower than coupon rate. Okay, if our coupon rate is equal to yield, it will be at a par. Okay, beta. And our current yield will be equal to coupon rate. Okay, student. Now let us try this example we have shown here. I'm just the example that we have discussed here. I'm just sharing with you, then it will be very clear to you. Now our coupon rate was 8 and yield was 10. Okay, so our price was 93.65. Accordingly, if we determine the yield, so our current yield 8 divided by 93.75 into 100. Okay, so you see our yield is current yield is higher than coupon rate. It will come 8.54. Okay, if our coupon rate is higher than yield, so it is selling at premium. Selling at premium, how much it is selling at premium? It is selling at a premium of 106.6.94 premium is there. So 8 divided by so current yield will be lower than our coupon rate. Okay, it is lower than our 8%. If we are selling at yield at par, so it is selling at par 100. So our current yield will be 100 into 100. So it means both are equal. So I hope the relationship between must be clear to you how we measure this relationship. Now we are coming to the IRR, that is how we yield the measure. In this case, what happens, student? Interest, we may be provided with the interest and we may need to calculate the yield. Okay. One second. Okay, student. Now, when we calculate, sir, why yield calculation first does not come 10%? And it is asking, sir, why yield we calculated in first case does not. See, student, beta. Student, yield is given. Here, the yield is given. Okay. In this case, let us go back to the question that I have discussed with you. In this question, yield has been given to us. Here, yield has been given to us. Okay, I have taken the reverse cases. Okay, so the yield has been given to us. Okay. Now, student, we are coming to the how we calculate. It is basically the IRR. Just read the slide, then I make you understand. Okay, student. Now, what is exactly? It is basically the IRR of any investment and computed in the same as we calculated IRR in capital busting. Now, here what happens, student? Sometimes we may be given, say, a company come out with a bond. It says, I will pay the 8% interest. Okay, I will pay the 8% interest for say 5 years. And after I will repay the amount as say 1100. Okay, now what happens? We want to compute the yield. What is the yield of this bond? Okay, so in that case, what happens? How we compute the yield? Just today we are investing 1000 rupees because it is selling at a par. Okay, 8% coupon. Okay, student. Now this value is unknown. Okay, we can find out this value by using the trial and error method. If you recall that. Okay, we take the discounting rate, then discount the cash flow, if you recall that. So we can do by that. Namita, in all three cases, yield is given? Yes, of course. In all three cases, yield is given. Now we are doing how we compute the yield. Now we are coming to the how we compute the normalized by the yield that we use discussing here. So we normally use the trial and error method. I think when we shall discuss the question, then we can discuss the example there. I think there are one of the questions. So, student, and I will, if possible, then I will discuss example in the next class. So I hope if you recall that R we used to calculate, and this normally used to be called KD. So it is just same way we can compute the yield. Okay, it depends on. So once the yield is computed, then we normally use the for a discounting. Or otherwise, we can say one thing. Of course, let us see. Let us compute the value. Compute the yield of this question. Okay. Now here, first of all, I'm just solving it for you. You also help me around this. Now first, let us discount it by say 6%. Okay. Now I discounted cash flow by 6%. I'm using the present value technique like we used to use in our intermediate level. Just help me around, student, for making the calculation. Student, please start calculating. Please correct me if any place I am wrong. Okay, student. Now let us compute this. Student, my mistake. I think this interest will be 80. Just make it like that. Okay, student. Just correct, beta. $75. Please see here, student. Our coupon bond is 8, coupon rate is 8, and our face value is 1000, and redemption amount is 1100. Okay, now accordingly I am solving it. And now I am just considering one. Let us discount the how we use the trial and error method. I am just discussing here. Okay, student, please calculate the value. 148.5. Harshad, let me check better because I think your answer may be correct. Namita, Harshad, please check your answer again because I am getting answer nearby to the Namita goal. Okay, you just check the answer again. Now our value somewhere around, my value is coming, this Namita's value is coming 158.66. It will be okay. Harshad, you check better because I think discounting factors, please remember whenever we take the discounting factors, always take up to 3 decimal points, nothing as I mentioned. Okay, now here the value is our positive. Okay, we have to reach our, what is IRR? IRR make our NPV is equal to negative. Okay, to make it our cash flow is negative, we have to increase our discounting rate. Okay, now let us discount it by 10%. Okay, so let us solve it by considering the, I have to use the space here. Okay, here, but a minus 1000. I just forgot here. So the value comes. Student, are you getting the same value somewhere near about this value? Yeah, of course. Harshad, your answer is correct. This time your answer is correct. Okay, thank you, Harshad, for giving us the correct. Now let us use interpolation formula. Okay, student. Now lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Okay, student. So our lower rate is basically 6%. Our NPV here was is 158.97. That is at 6%. Yes, Namita, your answer is correct. 158.97 plus 13.71, 172.68 into, but I think it is a 6%. Sorry, my mistake. It is a 4%. Okay, beta. So our answer will be 6% plus. Okay, student, just check it. So our yield will be 9.68%. Okay, student, if you recall that there way we used to use the one shortcut formula. It was something like that, I plus net proceeds minus, you can say here we shall use the redeemable value. Same way we can compute here. Minus face value upon N upon RV plus FP divided by 2. Okay? Accordingly, we say that NPV at our interest is basically 8%. So 80 plus redeemable value is 1180 minus, sorry, is 1100. It is 1000 divided by 5 upon 11 divided by 2. Yes, okay, Namita, your answer is correct. So we can, if we recall this shortcut formula, I think it is 20, and somewhere it is coming around 1100 20 plus this one coming. So somewhere it is coming out shortcut by 9.52. So it is proper. It is an approximation, but proper formula is this. Okay, student. So this is how we calculate the yield. Okay, this is how we calculate the yield. Now I hope the how we calculate the yield must be clear to you. Now I am coming to next, yield measures. Yield to fall. Now you just read the slide carefully. Then I discuss you. Now, yield is the price at which the product, or it can the same way call schedule can be call schedule prescribing the different prices at different times. Okay, it will be calculated the manner that we have computed here. Only difference is that when we have a here we have a normally schedule is there. So say 5 year, 10 year, 15 year. So accordingly, we shall consider this price as a maturity value. Okay, and we shall, it is maturity value 1, it is maturity value 3, and we shall consider the compute the value. Okay, madam. So now before I discuss the term structure, I think we should discuss some questions on assignment. Okay, students. Now this assignment is available to you. I am discussing their questions before we end some questions before we end up the class. And I think term structure we shall discuss in the next class. Please read the question carefully. Now in this question it says, find out the market price of the 10% Government of India security quoted at 110, but yield is expected to go up by 1%. Okay, student. Now here, first of all, we have to calculate the current yield, as we have a requirement of the question, current yield. Namita saying so we can say that it is yield. Yes, of course, beta, it is yield. Okay, it is the yield that will be accrued from the bond. Okay, because coupon is 8, but our yield is higher because it is getting redeemed at a premium. So this premium is also considered over the span of the tenure of the bond of 5 years. The impact is considered. Okay, beta. Now current yield is equal to our coupon interest okay accordingly okay student now it is our price it is our because since it is at a premium our coupon is only 100 rupees okay so see as I told you earlier whenever the quotation is given it is normally considered as a face value okay the face value is considered as 10 100 and 110% of 100 is our coupon payment and this is the price okay now it is said if the yield is expected to go up by 1% now if it is saying it is expected to go by the yield by 10%. Now let us see how we compute. Now our current yield is 9.09. So the revised yield is our 9.6. Okay, revised yield is our 10%. So now we can find out the value. Okay, it means how much the market price will be justified for the same. Okay, let I show you. We can say like that. Our yield is this. Uh, 1 minute. Now my expectation is this 10.09. So it means I want a coupon of 100 into 10.90%. It means I want a coupon of this much of interest. Okay. So I say like that. For a coupon of interest of this, I am investing this much of amount. Okay, 100. But for one, I need to invest this much. Sorry, I just taking it reverse. Just let me reverse it. If I invest 100, then I'm getting a coupon of interest of 10%. Okay. If I invest this much, or otherwise I do one thing, I just solve you just straight away I give you the formula, then it will be very much clear to you. Because that way you may get confused. Here, better student, please note, we can say that if I am expecting a coupon of 10%, this is this much amount, okay, and currently coupon is the board is giving 10 rupees, then how much market price I can pay for it, we can find out like that. Okay, so market price will be 99.10. Okay, likewise we can say that okay, student, very good. I think Namita, it is clear to you. Okay, student. Now let us go to the next question. Okay, now next, read out the next question, beta. Just find the answer. Student, please start solving the same. Now here in this, it says the bond with the 7.5%. Okay, interest and face value is 10,000 and term of maturity. So interest yield is 6% and interest is payable half year. That is semi-annual. Okay, now let us calculate how we calculate first of all. Okay. So 375, our yield is half, as I told you. Okay, student. Value comes to 10,278.48. Okay, student. Now you can see here, since our coupon is 3.7.5 and our yield is 7. Of course, so our yield is less than coupon, hence the bond price will be at a premium. Okay, student. Now question number 3, I'm just giving it for you for a homework. But here, please remember, consider the decimal point. Up to consider decimal points for PV factors. Okay, consider decimal points for the PV factor up to 4. Okay, only then you will, because here it will matter a lot in this, because here the difference is very minor. So please consider PV factor up to 4 decimal point. We shall discuss this question in the next class. But my request to you, please try it at your home. Now, this is a question that has come into November 2019 examination. Let us discuss its solution. You just read the question carefully. Now, in this question, it says the nominal value of 10% bonds issued at par by Messrs. SK Limited is 100. The bond is redeemable at par at rupees 110 at the end of fifth year. So determine the value of bond if required yield is 8, 9, 10, and 11%. When the value of the bond will be the highest. Now, student, here the present value factor has been given to you, and that up to 3 decimal point. So please remember, in the examination, whenever the decimal point have been given to you, and these PV factors have been given to you, please consider these PV factors only. Of course, they shall normally their chances of error are very less. Okay, but please consider up to how many decimal points they have considered. Please consider up to this much of decimal point only. Okay, now let us discuss the solution. Whenever required, yield is bond is 8%. Okay, so let us, I'm just drawing by way of table. Okay, here our 8%. Okay, present value is okay. Our cash flow is like annual cash flow because our bond coupon is 10%. Okay, now we have to calculate the present value factors. So what we do, we add up all these values. Okay, now the value comes 3.993. It comes 39.93. Okay, at the terminal year, it is redemption amount is 110, and our terminal, this is our PV factor. Okay, student. Now, similar manner, we can compute if required yield is 9%. Okay, so you can do it your own and match your answers. Okay, the answer will be 110.39. Okay, please do it at your own at your home. And if it is required yield as this, in case if any difference is there, we shall discuss in the next class. Otherwise, we'll proceed further. Okay, student. And there is a question is asking which value is highest. Of course, we can see the value is higher when our required yield is 8%, and that will prove our relationship. Now, one student has asked very interesting question. Sir, why we call it as a coupon? Interest are called our coupon. But students, I just tell you, it's a very interesting story behind it. In earlier days, when not, I think not in India, in US, when these bonds were used to be issued. So what used to happen? It consists of like the certificate like that in format. Say a bond is carrying 4 interest payments. So there normally 4 perforated coupons are attached to it. Say this is interest 1 payment, it is interest 2 payment, it is interest 3 payment. No, sorry, my mistake. I have to revert like that. It goes opposite like that. 1, 2, 3, 4. Okay, now suppose it is a yearly coupon. So suppose the bond has been issued on say 1/1/1993. Okay, so first coupon will be due on 1/1/94, then second coupon will be due on 1/1/95, then another coupon is 1/1/96, and then 1/1/97. So what happens whenever due date comes, 1st January 2009? So this coupon is detached from this certificate and directly deposited into the bank. Yes, Namita, your answer is correct. You started now. So this is used to be started. It is just like a check format. Okay, this is used to be deposited in the bank, or it is used to be sent to the company. So accordingly, that's why these are called coupon. Interest payment are normally called coupon. And it is very interesting to note that this is portion, principal portion. It is also traded separately in USA, and normally this is called split. Okay, this is the interest because this portion is even what used to happen. This coupon are separately traded, and this portion is also separate. So even an investor can sell off its principal. Okay, they can sell off their principal before the realization of their coupon. So this is separately traded in the market. This is also the case. So that's why I am saying fixed income securities market is not that much developed in India, but it is that much developed. Sir, can we say that IRR? But which IRR? Because required yield is basically IRR, and that has been given to us. It is basically the value of the bond. It is not IRR. It is the value of the bond at which it is a justified price that we should pay for the bond. Okay, students. So I hope today's session must be very valuable for you, and we have gone slow a little bit because I want to make you understand the basic concept. Now, in the rest of the questions, we shall continue in the next class. Till now, what we have discussed today, please you just refer the same, you just revise the same, because in the next class we shall come out. We will continue this topic. 1 minute. And we shall also come out with the other topics also. Okay, students, thanks a lot. Have a nice day. We shall meet you day after tomorrow. Thanks.